Every single month, thousands of businesses with incredibly healthy profit margins are just forced to close their doors forever.
Yeah, it's tragic, honestly.
Right. And it is almost never because they had like a terrible product or poor customer service or, a lack of demand. It's often because they had to wait 90 days for a massive client invoice to clear.
Oh, the 90-day wait.
Exactly. And their traditional bank took 60 days just to say a flat no to a short-term bridge loan. I mean, capital is oxygen in the commercial world. When you cut it off, even momentarily, the business just suffocates.
Yeah, that cash flow gap is, it's really the silent killer of the entrepreneurial dream. Because, you could be wildly profitable on paper and your projections can be stellar, but you can still go bankrupt by Friday afternoon if the actual cash isn't sitting in the bank account.
Just to make payroll or, pay the utility bill.
Exactly. If the cash isn't there, the math on paper doesn't matter.
Which brings us to the real mission of today's deep dive. We are looking at a company called Aventra Business Lending. And our goal today is to kind of pull apart their operational model and figure out how they act as a vital tool for ambitious small to medium enterprises.
Yeah, those SMEs that are really trying to scale.
Right. The businesses trying to navigate what is, frankly, a notoriously frustrating and opaque landscape of commercial funding.
It is an incredibly important system to analyze right now because over the last decade, the alternative lending market has just exploded.
It really has.
Yeah, they've stepped in to fill this massive vacuum left behind as traditional legacy banks have kind of retreated from small business lending.
Okay, let's unpack this. Because to really understand why a founder would even need a company like Aventra in the first place, we have to look at that traditional route.
A painful route.
Right, the painful one. When an entrepreneur realizes they need capital to, say, buy inventory or expand to a second location, the default instinct is usually to walk into their local bank branch.
Oh, sure. I mean, the local bank approach is deeply ingrained in our culture. You put together this massive physical binder of tax returns, profit and loss statements, and years of personal financial histories.
Just a giant stack of paperwork.
Literally.
Yeah.
And then you sit across a mahogany desk and hand it over to an underwriter who, honestly, likely has zero operational experience in your specific industry.
And then the waiting begins. You just sit in limbo.
Yeah. And that wait is agonizing for a reason. Legacy banks move slowly because they are, heavily regulated, profoundly risk-averse institutions.
They're using legacy underwriting algorithms, basically.
Exactly. They are essentially looking for reasons to say no. They want perfect personal credit,
Yeah.
massive collateral like the actual deed to your house, and years of flawless operating history before they'll release a single dollar.
And while you're waiting for that loan committee to finally meet, the opportunity you actually needed the money for is just gone.
Oh, long gone.
Right. I mean, if a competitor is going out of business and selling off their equipment at a 40% discount, that window closes in a week, not 3 months.
If we connect this to the bigger picture, the modern marketplace simply does not wait for a bank's loan committee.
Yeah.
I mean, speed is often just as critical as the capital itself.
Which is exactly the friction point Aventra is designed to solve, right?
Right.
And they are very explicit about their role. They state outright in their FAQs that they are not the direct bank. They refer to themselves as the middleman in between you and success.
Which is a bold claim.
It is. And I admit, it sounds a bit like marketing speak on the surface, but the underlying concept is vital. They are a bridge.
Or, to use a more technical term, they are an aggregator.
An aggregator, right.
Think about trying to book a complex set of international flights. You wouldn't call every single airline individually.
Yeah, no, that would take days.
Exactly. You wouldn't check their schedules, compare layovers, and cross-reference prices manually. You use a platform that plugs into all of them simultaneously to find the optimal route.
I use that travel aggregator analogy all the time. It's like a customized concierge service. You tell the concierge where you want to go and what your budget is, and they find the exact right route.
They do the heavy lifting.
Yes. Aventra operates this massive nationwide network of trusted lending partners. So instead of a business owner knocking on 50 different doors and filling out 50 different sets of paperwork like checking, every single airline Aventra leverages their technology.
Yeah, they match your specific financial profile with the lender most likely to say yes. And crucially, say yes quickly.
So if they are the travel agent, what exactly are the destinations they are booking for these businesses? What does that money actually look like?
Well, their service menu is incredibly comprehensive.
Yeah, it's vast. Let's actually dig into what these financial tools are under the hood. For instance, they highlight SBA loans, specifically mentioning the 7A and 504 loans and express loans with low rates.
Right. Small business administration loans, those are considered the absolute gold standard in commercial finance.
If you can endure the process to get them.
A big if. But what people often misunderstand is that the government is not actually lending you the money.
Really?
Yeah. The SBA is simply guaranteeing a large portion of the loan, sometimes up to 85% for the partner bank.
Oh, I see. Meaning if the business ultimately defaults, the government steps in to cover the bank's losses.
Precisely. Because the risk to the lender is artificially lowered by that government backing, SBA loans come with incredibly low interest rates and much longer repayment terms.
That makes sense.
The 7A is the most common, used for general working capital. The 504 is specifically structured for major fixed assets, like buying the real estate you operate out of, or massive manufacturing machinery.
Wow, okay. And they also offer straightforward equipment financing, right? This seems pretty self-explanatory for purchasing necessary gear to keep growing. But how do the mechanics differ from, like, a standard unsecured loan?
Well, with equipment financing, the equipment itself acts as the collateral.
Oh, okay, so it's built-in security.
Exactly. If you run a logistics company and you're buying 4 new delivery vans, the lender knows that if you stop paying the loan, they can simply repossess the vans.
And sell them to recoup their capital.
Right. It is a self-securing loan. Because of that inherent safety net, lenders are often much faster to approve these, and they rarely require you to put up your personal assets, like your house, as additional collateral.
Which is a huge relief for founders. And that brings us to working capital and invoice factoring, which is quick cash for literally any business purpose, right?
Right. Payroll, inventory, whatever you need.
Factoring is the one that really caught my eye, though, because of your earlier point about the 90-day wait for cash, getting paid up front for 30, 60, or 90-day-old invoices. How does that actually work in practice?
It is a brilliant mechanism, particularly for B2B companies. Let's imagine you run a commercial janitorial service. You clean a massive corporate office building all month, and on the first of the month, you send the client a bill for $50,000.
Okay, nice invoice.
But your contract stipulates net 90 terms. The corporation legally doesn't have to pay you for 3 months.
Ugh, brutal.
Meanwhile, your janitors need their paychecks this Friday, and you need to buy more cleaning supplies tomorrow.
That is the ultimate cash flow squeeze. I mean, you are rich on paper, but entirely broke in reality.
Invoice factoring bridges that specific gap. Aventra connects you with a financial partner who essentially buys that $50,000 invoice from you today.
Oh, they buy the invoice.
Yeah, they might advance you 85 or 90% of it immediately. So you get $45,000 deposited into your bank account right now to make payroll.
Right. And then what happens when the corporation finally pays?
When the corporate client finally pays 3 months later, the factoring company takes a small percentage fee for their trouble and gives you the remaining balance.
Wow. It's like selling your future paycheck today for like 95 cents on the dollar. You lose a tiny fraction of your total profit margin, but you gain the immediate liquidity required to just keep the lights on.
And crucially, you do not take on new debt on your balance sheet. You are just speeding up the velocity of the money you have already earned.
That is incredibly smart. And they list so many other tools, too. Business lines of credit, where you only pay interest on funds you actually use.
Yeah, those are great for seasonal businesses.
Exactly. And commercial real estate financing, covering everything from fix and flips to multifamily units. But I have to play devil's advocate here for a second.
Go for it.
With a list this long, invoice factoring, SBA loans, revenue-based financing, doesn't this just create a totally different kind of information overload for a stressed-out business owner?
Oh, absolutely.
If I'm a founder who just needs cash to survive a dip, staring at a menu of 15 different financial instruments might just induce sheer panic.
That is a very real danger. In finance, paradox of choice can paralyze decision-making. But this is where their stated mission really comes into play. Their goal is not to hand you a confusing menu, wish you luck, and walk away.
Okay, so what do?
They operate on a model of tailored financial consulting. Specialists customize and curate the loan to fit the exact need.
So they act more like a sommelier for your business finances.
That is exactly the dynamic. A specialist analyzes your specific operational situation. Are you trying to acquire a competitor? Are you breaching a payroll gap? Are you looking for debt consolidation or maybe franchise financing?
They figure out the exact pairing.
Right. They curate the specific loan product to fit the exact need. You, the entrepreneur, do not have to become an expert in the nuanced regulatory differences between a merchant cash advance and a revolving line of credit. The aggregator does all the matching and the translating.
Which naturally leads to the biggest, most pressing question for anyone listening to this. Who actually qualifies for these
The
tools?
golden question.
Because traditionally, we assume you need absolutely pristine financials to get capital. Now, Aventra is registered and operates primarily throughout the United States, but crucially, they selectively consider international lending opportunities on a case-by-case basis, making them a really versatile partner.
Yeah, that international reach is quite unique for this space.
But the part that jumps out the most is their stance on credit history. It's literally one of their most frequently asked questions.
Ah, the bad credit revelation.
Yeah.
It is arguably the single most significant barrier in commercial finance today.
And their materials explicitly address this. They say they can secure working capital for business owners with poor personal credit or even a previous bankruptcy.
Which shocks a lot of people.
It shocked me. To qualify, you generally just need to be based in the U.S., be operational for a minimum of just 3 months, and generate between $4,000 and $5,000 in monthly revenue.
Very accessible benchmarks.
If you meet those two simple criteria, they can fund over 90% of cases. I mean, wait, really?
Yes.
The leniency of that 3-month, 4 to 5K revenue threshold is wild. It makes funding so accessible for everyday Main Street entrepreneurs. But if a lender is approving 90% of applicants with bad credit, aren't they taking on massive risk?
Well, what's fascinating here is how this flips the traditional banking script. It shows lenders are fundamentally mitigating that risk without relying on a traditional personal FICO score.
How so? Because traditional banks treat that score like gospel.
They do. They look at your personal credit score as a proxy for your character. But many entrepreneurs completely ruin their personal credit because they are building their business.
Right. They max out personal credit cards for inventory.
Exactly. They miss a mortgage payment to make sure their employees get paid. The alternative lenders in Aventra's network look past those personal financial mistakes. They look at the daily cash flow of the business itself. They're evaluating current business viability and momentum, not past mistakes.
So they view the current revenue stream as the actual security.
Yes, using mechanisms like revenue-based financing. If your business reliably brings in $5,000 a month, the lender might advance you $10,000. But instead of a fixed, rigid monthly payment, they take a set percentage of your daily sales.
Ah, okay, so they connect directly to your point of sale system or your business bank account.
Right. They take micro withdrawals every single day. If you have a slow Tuesday, they take less. If you have a wildly busy Saturday, they take more.
That makes total sense. It dramatically lowers the risk for the lender because they get paid first, automatically, before the owner can spend the cash.
It is a completely different paradigm than a bank waiting 30 days for a paper check in the mail. It makes funding deeply accessible, but you are trading cost for speed and accessibility.
Which brings us perfectly to the execution phase. Moving from theory to execution. We know what they offer, we know who qualifies. The final practical piece of the puzzle is how a business owner actually gets this money in their hands.
And this is where the aggregator model really flexes its technological muscles,
Yeah.
because the friction of the legacy system is mostly removed.
The application process is incredibly streamlined. It's a straightforward online application that takes about 5 minutes.
5 minutes versus 5 weeks of compiling tax return.
Exactly. But the turnaround time is the real shocker. Once they receive your full application and supporting documents, the business gets an offer within 24 hours. Given everything we just discussed about analyzing cash flow, how is it technologically possible to underwrite a commercial loan in a single day?
It all comes back to open banking APIs
Mm.
and really sophisticated algorithms. Traditional banks have human beings poring over physical tax returns line by line.
Right?
The alternative lending platforms in Aventra's network use automated underwriting engines. When you apply, you grant them secure, read-only access to your business bank account. The software instantly verifies your daily revenue, calculates your average daily balance, and identifies spending patterns in seconds.
That is incredible. I mean, think about that, 24 hours to an offer. If you're listening right now, what could you do with your business if the funding wait time was entirely removed from the equation?
It changes everything. You move from defensive, reactive posturing to aggressive, proactive growth.
And it is worth noting that despite this heavy reliance on, algorithms and massive lending networks, Aventra provides a highly personalized, transparent service.
It really grounds the technology. It
Mm.
ensures it doesn't feel like you are just feeding your livelihood into a faceless corporate server.
Yeah, you have an actual guide. Their whole philosophy is that the business owner is the expert in growing their company. Aventra is the expert in getting the money to do it. It's a win-win.
Synthesizing all of this, Aventra's true value proposition isn't just the sheer volume of cash they can access. It's that bespoke navigation. They provide a streamlined, stress-free funding process that allows entrepreneurs to focus on what they do best, running their business.
It is the ultimate delegation of a stressful task. Having a customized, well-guided approach to capital can literally be the difference between a business surviving and a business thriving. Thank you so much for helping us navigate this comprehensive look at Aventra Business Lending today.
Always a pleasure. Analyzing how these financial engines work under the hood is crucial knowledge.
It really is. And to you, listening, I want to leave you with a final, lingering question to mull over. We started today by discussing how acquiring capital is the invisible, agonizing half of the entrepreneurial battle.
The silent killer.
Right. But if companies like Aventra have effectively removed the traditional friction and gatekeeping of acquiring capital, then the true test for an entrepreneur fundamentally shifts. The hardest part is no longer simply getting the money.
That excuse is gone.
It's entirely about how creatively and effectively you deploy it. If you got an offer in 24 hours, are you truly ready for what comes next?